Hello and good morning, folks. Welcome back to Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. And we have one of the hottest CPI numbers that we have seen, at least by the reactions that we are seeing. I mean, across the board, we have seen the moves happening, currencies sliding against dollar, equities having a different kind of a plunge altogether, yields moving, curves flattening. I mean, it was something unusual to watch, but it was something really amazing to see how a single economic indicator have changed the whole perspective and the sentiments of market participants across. I mean, all the forecasters are now switching their expectations of rate hikes from 50 to 75 to 100, and I love the kind of agility that they have in their lives with respect to their views. I mean, it's phenomenally good. I would like to have something like that in my health as well. But going forward, with all the Twitter traders and all the forecasters coming in with their sense of wisdom, I would actually want someone from the real sense of wisdom. JK, I would like you to tell us how should we be going ahead.
Yeah. Uh, so the inflation numbers were a rude shock to the market. And the market had gone into the data with optimistic expectations and also positioned accordingly. In fact, Monday's inflation expectation numbers had further intensified the dollar selling and also the buying in the stocks. But the big rise in core inflation dealt death blow to markets, and the reaction was intensified because of the way the market was positioned. Core inflation rose to 6.3%. Expectation was 6.1, while the last month number was 5.9. Barring the headline YOI number, which fell compared to last month, all other components have shown big rise. Uh, the details show that although there is a fall in energy commodities like gasoline and fuel oil, a rapid rise in energy services like electricity and gas, as well as the significant rise in food prices, medical care, shelter, and new vehicles have all added to the inflation. Adding to the jitters was former Treasury Secretary Larry Summers saying that the US has a serious inflation problem. He even says that a 1% rate hike in September can be justified, and once again reiterates that unemployment rate above 4.5% may be required to get the inflation down to the 2% target. And market started expecting even a rate hike of 1% in September. And some forecasters have upped the terminal rate even up to 4.5%. We now await the PPI inflation numbers tonight. It's expected to moderate minus 0.1% month on month overall and plus 0.3% on the core. But the recent experience of the forecast versus actual has been very poor, including the job numbers, and hence market will remain skeptical. Stocks were massacred, obviously, 3.2% fall across global indices. Dow minus 3.4, S&P 4.3, and Nasdaq a whopping 5.16%, being more sensitive to the rate situation. It's not only the expectation of higher, heftier interest rate hike and the terminal rate, but also the fact that further tightening in financial conditions will slip the economy into a deeper recession, and that is resulting in a bigger sell-off in the market. Even in the stocks, the positioning was on the bullish side just before the data. Yields, of course, sold off. Bonds sold off what aggressively. 2-year vaulted 29 BPs from the low of the day, 3.5 to 3.79. 10-year from 3.29 to 3.46. Well, 30-year remained almost stagnant. Dollar, along with other risk assets, particularly the short-term market, played a big part in massive upsurge after the CPI data. Market had even ignored some of the softer numbers from Germany and UK, uh, like the new business sentiment as well as the employment data from UK. All the currencies had driven higher but that was completely reversed after the data. Dollar index rising nearly 2%. Yuan is not far away from 7%. Dollar yen almost 145. Just that we managed to be slightly above the previous cycle lows. Now it's important to see how central banks react to the return of their currencies to multi-year lows, and their statements indicate resistance to these falls in policy statements from Japan and China could be watched very closely. Almost the euphoric mood was seen in the rupee yesterday after it broke the support at 79.30, with the stop losses driving it lower to 79. There was a rumor of large inflows. There was absence of strong buyers in the first few hours, as well as spillover of a positive sentiment from the stock market. Apart from stop loss selling had aided the rupee's move, but the overnight dollar index moves puts it back about 79.50. Possibly short-term players who had gone short might be rushing to cover, and then importers who might feel having missed out a dip might come in to buy on any dip. So we are broadly continuing the range of 79.80. 79.30 support may prove even more resilient now, since we have seen it as a false break yesterday. Indian bonds, of course, had hit low in the yield at 7.11, but that might see a fresh surge today after the global bond yields have risen. That's all from me.
Okay, JK, and that was quite crisp, short, and wonderful to understand how the inflation is not looking so good, and how the expectations for terminal rates have moved from 3.5, 3.2, and 3.7, and I don't know, numerous levels to now 4.5%. And the expectations of the rate hike, which can be quite significant by a 1% whole on the next FOMC meeting, it's quite significant, and the aggression that the market expects out of Fed is quite interesting. And generally, it has been seen that Fed is a bit reluctant on going against the market expectations in these terms. So it is to be seen in the next week's FOMC how and what would be the rate hike percent. 0.75 or 1. But at the same time, on the domestic front as well, folks, the global massacre will not also spare the Indian markets, at least for the day or two. So we can see a good gap down opening, while a gap up opening in the currency. And as JK mentioned, we can expect a continued movement in the range, with both side players acting on their missed out levels. So folks, I hope you guys are managing your risk, because these markets are quite volatile, and risk management is must at these kind of movements. We will come up with another round of updates tomorrow morning as the financial markets continue to churn with a lot of data points coming in. Thank you so much for listening today, and we shall come back tomorrow morning.